All right, today we're going to tear down the latest financial report from one of the Philippines' biggest banks, BPI. We're going to get into the nitty-gritty and find out the real story behind those big headline numbers for the first 9 months of 2025. And wow, what a headline number it is. 50.5 billion pesos in net income. That's up over 5% from last year. It's a huge figure. But the real question isn't just what they earned, it's how. How exactly did they pull this off? And maybe more importantly, what challenges are hiding just beneath the surface? Okay, so let's start right at the top line. Total revenues hit a massive 142.3 billion pesos. But where did all that cash actually come from? Well, it really boils down to two key engines. And what's really striking here is the breakdown. Look at this. Over 3/4 of their revenue, a whopping 109.1 billion pesos, comes from just one source: net interest income. This is the absolute core, the heart of BPI's business. And it just dwarfs the 33.3 billion they earn from everything else, fees, trading, and all their other services combined. So what is net interest income? Well, to put it simply, it's the bread and butter of banking. It's the profit a bank makes from charging more interest on the loans it gives out than it pays to you and me on our savings accounts. It's the fundamental profit engine. And that core engine? Oh, it is running hot. BPI grew its net interest income by a really powerful 16.2% compared to last year. And just to be clear, this isn't some small bump. This is a serious acceleration in their number one source of earnings. So what's fueling this? Well, it really comes down to two things. First, they just loaned out more money. Simple as that. Their total loan portfolio surged by over 13% to hit 2.4 trillion pesos. But it's not just about the volume. They also got more profitable on each and every loan. Their net interest margin, or NIM, expanded to 4.60%. That basically means the gap between what they earn on loans and what they pay on deposits got wider, making every single peso they loaned out that much more profitable. But as we all know, rapid growth never comes for free. So now let's flip the coin and look at the other side of the ledger, the costs and, crucially, the potential risks that come with this kind of expansion. So naturally, as the business grew, so did their expenses. They spent 65.5 billion on operations. That's a 10.3% increase, mostly because of investments in new tech and just the cost of handling more business. But here's the crucial point. While expenses went up, their total revenues grew even faster at 13.2%. That means the bank actually became more efficient. That's a very, very good sign. But there is one number buried in this report that signals a major, major shift towards caution. It's a data point that really suggests the bank sees some potential turbulence on the economic horizon. 144.8%. That is a massive jump. And it points directly to how the bank is starting to look at the risk that might be hiding inside its loan portfolio. So what does this number represent? It's the increase in the amount of money BPI set aside to cover potential losses from loans that might go bad. They beefed up these provisions to 11.8 billion pesos. Now let's be super clear here. This does not mean these loans have gone bad. It means the bank is getting much more conservative and is preparing for that possibility. It's a really clear sign of proactive risk management. And this whole idea brings us to the concept of non-performing loans, or NPLs. These are the loans that are already delinquent. So while BPI is stocking up its war chest for future risks, their actual NPL ratio right now is holding steady at a stable 2.3%. These provisions are basically a buffer to keep that number from jumping up unexpectedly. So, with all this rising caution, you gotta ask, how healthy is the bank's foundation overall? Let's take a look at a few vital signs to get the complete picture. This table gives us a fantastic snapshot. First, like we said, the non-performing loan ratio is stable. That's good. Second, their cost-to-income ratio is improving. They're getting more efficient. Now, you might notice that return on equity is a little bit down. This is simply because their total equity, the actual value of the company, grew faster than their profits did. You can think of it like they're investing in building a stronger foundation, which might temper short-term returns but creates long-term stability. And finally, and this is so important, their capital adequacy remains very strong. So what is this capital adequacy ratio, or CAR? Just think of it as the bank's financial shock absorber. It's the safety cushion it holds in case things go wrong. Regulators set a minimum level that banks have to maintain, and BPI's CAR of 15.8% is comfortably above that requirement. That means it has a very, very strong safety cushion to absorb any unexpected losses. So the picture we're getting is of a strong, profitable, but increasingly cautious bank. So for our last section, let's look at where BPI is placing its bets for the future. The report highlights three really key things here. First, a big strategic move into Asia with the launch of BPI Wealth in Singapore. Second, a huge vote of confidence from the credit rating agency S&P Global, which maintained their strong BBB+ rating. And third, S&P also confirmed a stable outlook, which signals they believe BPI is on very solid footing for the future. And this quote from the bank itself really frames their ambition perfectly. This move into Singapore isn't just some small step. It's a clear strategy to connect their clients to a global financial hub and really push their expansion beyond the Philippines. And that leaves us with this really fascinating picture, doesn't it? On one hand, you have BPI just firing on all cylinders, with truly impressive growth. On the other, it's very prudently building up its defenses for whatever risks might be ahead. So the central question is this: can this combination of aggressive growth and careful preparation be the right formula to navigate whatever economic challenges are to come? For BPI, and really for the broader market, only time will tell.